Hello friends, welcome to another day when we are discussing the stock market which touched 60k and what is going to happen after that. When the market goes up or when the market is coming down, what prevails is the wisdom of the investor. As we have already said, the market goes up and greed also goes up. Here we have two things which we need to understand. One is how the finances are invested or kept in your debt account. And the second one is how much equity exposure you have. The debt equity ratio of your portfolio is very important when the market goes up or moves down, in whichever way the market moves. And we will see that in detail today's what we call short session. And the second thing is, as I have promised, how the three global markets, the big US market, the Japanese market and the Chinese market have performed in the past, which has that got any relation to Indian stock market indices, whether it is any connected with that. We know the FII activity is happening, all these things, these two important facts we will check today. We have seen in the first episode, we have seen how the sentiments and the liquidity works. In the second, we have seen how the fundamental aspects, the PE and the PB ratios, how they are going to work with our market. And today, we will see these two important things. And if you have not subscribed the channel, please subscribe the channel, post your comments and like the video if you really like the video. This is KARMANTA Research and Analysis and myself, V. Ramesh Kumar. Friends, as I have already said, the debt equity. We have something called the savings and the financial instruments. And the shares are, as you all know, are financial instruments. The financial instruments are something which are tradable. Your savings bank account is not tradable. If you invest some money in that, say if you invest 10 lakhs rupees in the savings bank account, your SP account, your fixed deposit, bank deposit, the bank says this much interest will be guaranteed for this many years and you will get. It is not tradable. But your shares are tradable. Your ETF is tradable. Your mutual funds are tradable. And we will be doing a detailed what we call video on the mutual funds and the ETF in a short time from now, how that moves, how the derivatives works. All these will come in a short time from now. And just to understand that these are tradable, the tradable product means there should be a willing buyer. If you want to sell something, you need to have a willing buyer to purchase for the price you have quoted. This is the most important part of any trade. You quote a price, you need to have a buyer on the other side. So, in the stock markets works based on the principles of buying and selling or selling and buying. You need to have a buyer. Again, we will see a small example. Quickly, we will go through a small example how this trading works. Say Infosys. Infosys, as you know, Infosys has got its own share price, but we will say the share price of Infosys today at this point of time is 1000. And yesterday this was trading, the last traded price when the market were closed, it was 850, which means that today the Infosys share price has reached 1000 from 850. This doesn't mean that millions of shares have been traded for Infosys. You know, Infosys has got a lot of shares with it. This doesn't mean that all the shares are traded in the market. Maybe if I sell 1000 Infosys shares for 1000 rupees and there was a willing buyer and he has purchased that. This means that even though the other shares of Infosys has not been traded, all the Infosys shares will reach that price of 1000. This is a basic fundamental. This is related to any sales. If you go to a market and you purchase some onions and the onions priced at 25 rupees. You go to a supermarket, you purchase 1 kilogram of onion, 25 rupees. You will see bags of onions kept there, if it was not sold. What is the price of that onion? Even if that is not sold, the price is 25 rupees. Maybe after 1 week you go to the market again and they say that the price of onions, that area became a containment zone, as we say, and it was not functioning. The same onions were kept there after 3-4 days and they say the price of the onion is 20 rupees, which means that day the price is 20, the other day it was 25. This is the same which has got connect to the market. The Infosys price today, if I sell and if I get money, that is 1000 rupees. That we call as real money. Otherwise, the stock price 1000 today, 1200 tomorrow, you see the price your kitty has got, but it is not real money. The real money is made only at the point of sale. Which means if the market goes down from here, I think I have purchased for Infosys for 520, suppose that. And today, as I have said earlier, it is 1000 rupees. And tomorrow if the market corrects, it's 900. I wait, the Infosys is going to come up. I wait, it has reached 600, 500, 450. Then suddenly I panic because every bear market is connected with fear. What I have said, the bull market is based on greed, the bear market has got its underlined fear. And what happens? The Infosys price is now the price which is below its trading price, as in the example we have seen. Then what happens? You have only one choice. You have to wait, or you have to sell at a price which is going to make loss for you. This is what happens when the market falls rapidly. You put a price for sell, you don't get it. You don't get it because people are there to sell for lower prices. This is something which you need to be very cautious about. And here we'll have, as I'll speak about one or two examples. One is the Japanese market. The Nikkei index was, you know that in 1985, the index was at 339,000. Unbelievable. When the Indian stock market was trading below 1000, it was 39,000 in 1985. Because you know the BSE Sensex has started only in 1986 with the prices, the base price of 78, 79. The index has started, the Japanese index was trading at 39,000 in 1985. And what happened? In 1989 to 2002, it was the level was, it has come down to 8,000 in 2002, about 80% corrected. Think. And from 2002 to 2008, when we have seen the global rally that happened, and 2008, the entire indices and entire markets fell, and it again corrected back. In 2008, it was 60,000, then it was back to 8,000 again. And do you know where the Japanese market is trading now? It is trading at 25,000 levels. The long-term investor, the traders have made a lot of money in between, and today the market has never come back to the highest level. This is an example of the Japanese market, and now the market is riding on, as we say, liquidity alone. As we know, the growth in Japan is almost zero or negative, and liquidity is the only factor that is there. Then if we see that is the liquidity factor, we will go to the biggest market, as we know, the what we call the growth engine of the world, the US, the United States of America, the broader S&P 500 index. In 1998, it was 1000 points. 2 years later, in 2000, become 1500. Again, you see, in 2002, it was 750 points. And in 2007, it became 1500. That means from 2000, it was 1500 points. From there, 7 years, it never touched the 1500 points again. And after that, 2007, the big fall happened, and it has gone down to 650. And it remained there, 650, 1000, 1500 for so many years. And now the US government has provided enough liquidity, as we did, by printing so much currency, the liquidity available, and the interest rates were cut down. So many things they did, and it is now trading at 4,500 levels. So these two markets we say based on sentiments and liquidity means there is a market which is riding on growth, the Chinese market, the Shanghai Composite Index. China, as you know, the only country which is growing at double digit what we call growth. The economy is very strong as is perceived from outside. And in 2007, the Shanghai Composite Index was at 6,100 and it fell to 1,700 within a couple of years, and now it is trading at 3,500 levels. Just see this, 6,100 in 2000 level, it fell to 1,700, now 3,500, not to the highest level. China is an economy which is very strong in growth. The fundamentals are strong, sentiments are good, but growth alone does not constitute the what we call the growth in the share pattern. The share market does not depend on all these things. And we come to the Indian stock market. We have talked about that. In 1990, it was 1,000 levels and 1,500. It reached 1992, as you know, it was the heavy pull that has the Manmohan Singh effect of the LPG has pulled it to 4,200 levels. And what happened? The Harshad Mehta scam came after that, and then it had some ups in between. The .com, as you know, the some ups have happened, and it reached 10,000 in 2000. As you know, 2004, it took 12 years from 1,000 to 10,000, 3,652 trading days it took. It was slowly coming that, and in from the 20,000 levels in 2000, as you know, 2008 it was trading at 21,000. From there it was a drastic fall below 10,000. Then what happened? Then it was back to 25,000 when Prime Minister Narendra Modi won the elections in 2014. From there 25,000 Sensex to 60,000 Sensex, almost 35,000 points in 7 years. Unprecedented bull run happened in the Indian stock market. Thus, how long it is going to continue in the market? The longer the bull market, the larger the bear market. I repeat the sentence once again, the longer the bull market, the larger the bear market. If it was a strong, heavy bull market for the last 8 years, expect a bear market for 10 to 12 years after that. This is what history says about. And the higher or quicker the market climbs, the deeper the market fall. We saw that 8 months from 50K to 60K, which means it won't take 8 days from 60K to 45K. The market coming doesn't mean, and I was talking about Infosys before I conclude, every bull market has got something which we call as the angel shares. And we will see that formerly Unitech, in the last bull run, it was Unitech, Aban Offshore, Reliance Communications, Kingfisher, Jetware. These were angel shares in the previous bull runs. Where are these shares? So, in a bull run, the share price goes up considerably, and when the market falls, it comes back. Doesn't mean that the same share is going to come up in the next bull run, because every bull market has a characteristic angel stocks which may not be the same in the next bull run. So, this is another thing, and I want to talk about the mutual funds and the ETFs separately, but I will tell you the mutual funds and ETFs are long-term investments, and if you put all your money in that, if it is going to be a bear market from now, how the returns are going to happen? So, when the market is going to fall in the next time, or a bear market is going to happen, how the mutual funds are going to function in that market, how the ETF is going to function, and these are things which need to have a detailed looking, and we will detailedly look into that. And as I have said, how the portfolio, how the debt equity portfolio of each individual. People say you can have 40% debt and 60% equity, and how this is to be worked out, that is also going to be looked up in another video, which we have to see in detail the portfolio, how we should manage that and how we should keep that. And about what do you call your sentiments working on this bull market. This market is moving up again and again. When I speak about this what we call this episode also, the market is moving up. How long the market can go up? Let the market reach 70,000, 80,000 or 1 lakh, but as an investor, be cautious and get expert advice, because you can ride high in a bull market. When the flood comes, everything goes up, and when the flood recedes, you do not know who are all standing naked. This is an important factor as far as stock market is concerned. Get the best expert advice and move in the market. And let's have the third episode closed here. We will come with the debt equity ratios and the ETF, and in the next episodes coming up. And thank you for watching. Post your comments and like the video if you have liked. Thank you so much.